All right, everyone. It's a few minutes past 2. We're going to go ahead and get started. Thanks, first of all, for joining us for two reasons against kind of a crazy backdrop of kind of unprecedented times, for lack of a better term, as well as if you're here in Colorado, a beautiful day to actually be taking advantage of being outside when we've all been locked up for a little while. So we appreciate you taking the time and being here. Just a couple of housekeeping things. My name is Stephanie Copeland. I'm a partner here at 4 Points Funding. I'll be joined by John Lettieri, who I'll talk about in a second, Chris Montgomery, another partner at 4 Points Funding, as well as Sean Bertini, who is sitting here with us, not physically with us, but virtually with us in 4 Points Funding, and Marco Vienna, who will be helping me facilitate slides. He runs business development for the firm and will also be facilitating Q&A. The structure of today's webinar will be an overview from John, and we will then open it up for Q&A. And if you can, please type Q&A in the Zoom Q&A section. We will then facilitate the Q&A. If we don't get to a question that you've asked, we will be sending out a summary as well as a recording of this webinar and answers to all the Q&A that we've received. We'll then move on to 4 Points Funding section. We'll go through where we are, the state of the environment here, and we'll also open the call for Q&A. We have an expected close to 90 investors on the phone, mostly made up of our base of investors, but also community partners that we both thank and are grateful for you joining. And with that, I'm just going to introduce quickly John Lettieri. John, many of you may have heard his name. He is the founder and CEO, co-founder and CEO of the Economic Innovation Group. And over the past few years, both working with the governor and post that tenure, I've gotten to know John pretty well. I have great admiration for John, the work that he's done in both sponsoring really impactful legislation around the country with regard to facilitating more inclusive growth throughout the country, also selfishly promoting dynamism expansion across the country, and most importantly, and relevant to this call, one of the lead architects in this legislation and one of the people that are most effectively organizing the ecosystem and ensuring that our congressional partners are supportive and continue to provide productive enhancements to this legislation. So with that, I'm going to hand it over to John. And John, we have control of the slides, so we'll start with the presentation and we'll turn it over to you. Thank you very much for joining us today.
Great, thanks, Stephanie, and hopefully everyone can hear me. It's great to be with you, and so I'm going to cover a few things in my remarks, and then look forward to taking some questions. We'll talk a little bit about what we're seeing in terms of market formation and types of activity. Transition to the outlook legislatively. How is Congress thinking about opportunity zones? How does it fit into the current legislative context? And that should be just about it. And then we'll turn over to some questions. So first, on the first slide, one of the challenges with evaluating opportunity zones in its infancy is that there's not a singular point of comprehensive data that we can point to. So far, the federal government's not tracking or requiring funds to track their own activity in any kind of comprehensive or searchable way. So we're really in the world of anecdote on a lot of this, and at best, we can look at some voluntary survey data to evaluate how the market is standing up, and we can look at anecdotal evidence within communities and to some degree tax information at the state level to see what kind of uptake we're seeing. One of the best sources for data on opportunity zone fundraising and fund formation is the accounting and compliance firm Novogradac, with whom we've worked very closely over the last few years. They have a rolling survey of which is opt-in that only looks at a subset of funds, and that subset is funds that reply to the survey that are raising third-party capital. So that's only going to cover a very small portion, a relatively small portion of the total universe of opportunity funds and opportunity fundraising. But it's a meaningful proxy for understanding the growth of the market and the diversification of the market as well. So as of January's data, which is the last release that they had seen a really massive uptick. We look from October, they were below 4 billion in total reported fundraising from that subset of the market. By January, they were at over 7.5 billion. I think it's very likely the next release that they do, they'll be reporting 10 billion or more in total fundraising. And again, that's just from those who are voluntarily reporting confirmed third-party fundraising totals. So this is money in the fund, not soft commitments or anything else. Likewise, we see with the growth of qualified opportunity fund formation itself, the same type of steady uptick really starts to kick off in the third quarter of 2019. One of the things that's dictated, I'd say more than anything else, the nature of the marketplace so far and the willingness of investors to dive into this has been the regulatory implementation process. It's something we've been at EIG deeply involved in. And that, at best, you could say got off to a rocky start. Treasury took the approach of doing relatively few rounds and waiting to put out anything in terms of formal rules or guidance until they had a lot to say about each tranche, which meant that you had these dry periods in between October 2018, when the first round of rulemaking came out. More than 6 months elapsed between that and the next round. Each one left a ton of unanswered questions. But by the end of last year, you had the final rule introduced or released. And it wasn't until that final rule, really 2 years into the life of the program, that you had the kind of answers that allowed the operational flexibility that was necessary for a whole range of opportunity zone related activities. So we ended up in the right place, but in the meantime, for many types of uses of opportunity zones and for many investors, there simply wasn't enough clarity and certainty to dive in. That's no longer a problem. I think for the vast majority of plausible use cases, the rules have not just answered the question, but answered them very favorably. And so now the taxpayer friendliness of the regulatory regime around opportunity zones has helped to facilitate at least until the recent crisis has hit, a very steady uptick in fundraising and in deals closing, in funds forming, as you would hope to see by that point in the program. The other piece that's dictating market activity is just simple awareness and comfort with this new tool. It's a brand new thing. It takes a while to orient at every level: the individual funder, the fund manager, the state and local governments who are putting their own incentives and policy and regulatory tools in place to help accentuate the impact of opportunity zones. So at every level of the process, there's a learning curve. And I'd say by the end of last year, most of the kinks had been worked out, and 2020 was set to be a real execution year. If you want to look at, we'll go to the next slide. If you want to look at the next, look at a single snapshot of the diversity of market activity around the country, you can go to our website and look at the Opportunity Zones activity map. This is not a comprehensive listing of all projects. And again, that's not possible because there's nothing that mandates a public report or disclosure of an opportunity zone deal, but that which is publicly available and interesting, we have tried to put in one place so that a user can quickly scan across a number of different types of investments, a number of different types of funds, and also local initiatives, state and local initiatives that have a relevant role to play in how opportunity zones are being implemented in a specific place. And so if you look at that map, you'll see that the early market of opportunity zones has without a doubt tilted towards real estate in a variety of different types of use cases, but real estate has been the dominant use so far. And again, a lot of that is a function of the regulatory process itself. The regs prioritized and created a glide path for real estate investment that they did not for operating business investment. And it was not until the very final rulemaking that the needs of operating business investors and some of the practical questions around how that can be executed were fully answered. So that part of the market was already going to be more difficult to stand up. Just the nature of investing in operating businesses is different and has more variables, but the regs process made it even more complicated until the very end. Again, most of those issues have been resolved, but you see in terms of what was shovel ready when the bill passed, the early market movers were overwhelmingly in the real estate space. And that runs the full gamut of everything from student housing, affordable housing, workforce housing, market rate. So the full gamut is represented there. You often see opportunity zones being paired with other federal incentives like LIHTC, as well as other state and local incentives, depending on the use case and depending on the place. You have a lot being done in the energy sector, clean energy investment. You have some good examples in higher tech industries. There's a robotics company, for example, that got a lot of news from moving from Silicon Valley to Baltimore and got an opportunity zone funding round that way. In fact, opportunity zones were the big reason that they made the move when they did and how they did. So there's a wide gamut, everything from very basic local amenities like housing, healthcare facilities, grocery stores, things like that, on up to more sophisticated and larger scale investments. You see a lot of sports anchored investment happening where there's a soccer team that's building a stadium surrounded by mixed use development. The biggest investment in Rhode Island, for example, in Pawtucket is a sports anchored investment, and that's a model that we see being replicated in many places around the country. So the gamut is wide, which reflects one of the fundamental policy goals behind opportunity zones, which is to have an incentive that's a malleable way of meeting a wide range of needs in a wide range of places. No two places are alike. No two places have the same set of assets, the same set of challenges or needs locally. And so Congress really wanted something that was able to right size to different funding scenarios, to different capital stacks, to match with other incentives. And I think the early lesson from the marketplace of opportunity zones, especially once the rules were clear, is that that's exactly how it's being used locally. So there's a lot of diversity there, and I think as the market matures, that's only going to continue to diversify, and we'll see the non-real estate use cases start to scale up pretty considerably. If we go to the next slide, we can talk about the legislative outlook. Congress, if you know anything about tax policy, you know that Congress never takes just one bite at the apple. There's always an iterative process. They always revisit, and tax reform is no different. So on the one hand, you had a relatively massive and rushed product and process that's going to leave clerical errors, technical glitches, and other mistakes that have to be cleaned up. Congress is still in the process of doing that, and then on the other hand, you have policy iteration, just design iteration that Congress wants to do over time as they learn more about how a program is being implemented. One of the pieces of unfinished business with opportunity zones, though it enjoyed broad bipartisan support in its inception, was the fact that there wasn't a federally mandated reporting requirement attached to the benefit that opportunity zones delivers to taxpayers. And so there's broad bipartisan support for taking what was in the original legislation that didn't get passed as part of tax reform and renewing and expanding that piece of it. So the simple way to put this is that if anything additional happens with opportunity zones in the future, the safest bet is that it will include some kind of reporting and transparency requirements that don't currently exist, and that Treasury and the IRS do not feel like they have the authority to implement without congressional direction. So this would be to provide congressional direction. And the best place to look to understand more or less what Congress would do if they pass such a provision is the Impact Act. This is sponsored by Senator Tim Scott, who was the original sponsor of the Opportunity Zones legislation that made it into the tax bill. It would, in effect, make Opportunity Zones the most closely measured and transparent place-based incentive ever to be implemented. And it's something that we support because we think this is not just good public policy, but it's important to the long-term sustainability of the policy for people to feel, both the general public and policymakers, to feel like this is a program that is serving its intended purpose. And there's no way to justify that without having objective data to point to. So we've worked closely with the senator and his colleagues to make sure that the burdens are not onerous and that they don't tip over into creating an inadvertent disincentive to actually go through the program because of how much compliance headache and paperwork is involved. These are essentially all things that a fund manager is going to know and have to know in the course of doing their job anyway, and just creates a reporting process to capture much of that information, and to also do so in a way that doesn't compromise proprietary or competitive information. There have been a number of pieces of legislation introduced that all aim in this general direction. Some are terrible, some are great. I'd say this one's great and also has the benefit of being the most likely to pass of any of the pieces that have been introduced so far. So that's why I highlight this. Beyond that, there's an open conversation about what else can be done to enhance the benefit of opportunity zones by tweaking some of the underlying mechanics of the legislation. If you know anything about opportunity zones, you know that it's a graduated series of benefits that all nest under the broader opportunity zone program. And so those benefits are all tied to longevity of your investment. And two of them, or one of them that happens in two places, is the step up in basis that under the original legislation would happen after 7 and 5 years of duration. So after 5 years, you get a 10% reduction in your original tax liability. After 7 years, you get an additional 5 for a total of 15% reduction in your original tax liability. Well, the 7-year has already passed. That window closed with the end of 2019, and so there's a lot of talk about pushing that back and extending that runway further for investors so that there's more time to capture that maximum benefit in the step up. And for one very simple reason, which is it took 2 years for Treasury to implement the regs, and that was 2 years that kept a lot of investors off, on the sidelines and not investing. And so doing that extension would allow the market to recoup the lost time that Treasury took and further enhance interest in participating in opportunity zones and helping the market form as Congress intended. That's one of several potential changes that would be additive, ones that would enhance the overall benefit, ones that would make it easier to do things like invest in affordable housing, which is another big priority for a lot of folks on the Hill, that the original bill did not go as far as some would like, and certainly the regs have not gone as far as some would like in making it easy to use opportunity zones for affordable housing. So there's a lot of political interest in those types of provisions. There's also interest in enacting stronger guardrails in certain ways, principally the transparency reporting that I mentioned earlier, but that also extends into identifying some of what I would call the bad tracks, the tracks that governors nominated, not in Colorado, but elsewhere that maybe have no business being an opportunity zone. I think those are less likely to pass, but certainly when you hear things that Congress is considering, that's one of the options that sometimes comes up. So I'd say of all the things in tax reform, which was a package of legislation passed on party line vote, opportunity zone stands out because it was at the time one of the most bipartisan provisions. It had the underlying legislation for opportunity zones had a wide spectrum of co-sponsor support from Republicans and Democrats alike, and I really mean hard conservatives and hard left progressives and everything in between. It's very hard to map politically who supported opportunity zones. It was as broad a coalition as you could possibly assemble, and now that it's passed, you have some of the most aggressive advocates for it are state and local Democrats who are seeing the impact that this policy is having on the ground in their communities and want to fight to protect and expand it. So it doesn't map onto traditional party divides and the left-right, red versus blue divide that a lot of tax policy, a lot of policy in general, gets sucked into. That said, we live in strange and divisive times, and so you'll hear on the margins some debate about opportunity zones as it relates to the administration and certain people within the administration. I would not be spooked by that. I think the support remains broad and bipartisan. It remains very deeper than it's ever been at the local level because of how entrenched this now is in local economic development, and how many parties now are seeing the fruit of the policy in their own backyards. So I think it's durable from a political standpoint, which is important in a market context. People don't want to participate in a program that could be gone tomorrow, and I don't think there's any chance that that's the case for opportunity zones. So I'll close with the COVID situation and how we see that affecting market activity. My answers here are somewhat unsatisfactory. We know that this is a, we're kind of running out of ways to say this is an unprecedented, unparalleled crisis. And when I'm not thinking about opportunity zones, I'm thinking a lot about the nature of this crisis and the economy as a whole, and what we're going to do about this to get out of the hole that we're digging. And it really is unlike anything we've ever seen, and there's no playbook for how to address it. I can tell you for sure, unlike the Great Recession, where we didn't have a tool like opportunity zones, the fact that opportunity zones exist now is going to be a big deal for a lot of communities that need to bounce back after this crisis is over. So I think the relevance of the policy has never been more clear than it is today, and will only become more clear over time as we move from crisis response to rebuilding. The short-term market impact, I think, is disruptive, as you'd expect it to be, and that's true of just about everything in terms of investment and market activity. There's the practical question of, can projects actually move forward if people are in a shelter in place or construction work has stopped by local mandate. There's questions about the availability of capital that might have once been counted on, but the sell-off actually created a lot of capital gains that are the source code for this policy. And so it does cut in both directions. The uncertainty is pretty pervasive, and I can imagine that may be something that, until the worst of the uncertainty is lifted, may keep some investors sitting on their hands. But on the other hand, a lot of investors are now on the clock with capital gains that could be deployed into opportunity funds. And with the 10-year plus horizon for opportunity fund investment, it allows you to kind of leapfrog the current uncertainty and the current market conditions and make a longer term bet on areas that still have a lot of upside. And we'll be seeing hopefully a very strong bounce back once the crisis is over. So in the medium term, I think things will stabilize. In the short term, there's just a lot of uncertainty. This again is where I think Congress and the administration can do more to inject a new burst of energy and interest in opportunity zones with some relatively modest legislative tweaks that enhance the value of the incentive and will draw in investors who might otherwise be cautious given the broader macro uncertainty that we're seeing. But I'm still pretty bullish. Again, I'd feel much more uncomfortable if we were still in the middle of the regulatory process and if there wasn't the kind of clarity that we have now. But right now, it's just a matter of market formation and going out and building this thing. And I still think there's going to be a ton of utility for this type of a program, especially in the context we're in now, where there's going to be so much emphasis on getting investment flowing again and getting capital to these communities to not make the same mistake that we made with the last recovery, which is to leave a lot of the country behind. So the political imperative behind that is incredibly strong, and opportunity zones is really the principal policy response to that imperative. There is no other policy of this scale that fits squarely within that context to make sure that we don't just have a recovery that benefits the top places in the country or the top people in the country. And so again, I think you'll see that coming to the forefront as we move further away from crisis response and more into a debate about how we rebuild, what type of policy is important in that context. So let me stop there. And well, I'll just say one more thing. The infrastructure that's been built, this is the last slide, slide 6, the infrastructure that's been built around the country in terms of community intermediaries makes a big difference as well. There's all kinds of local organizations, market facilitators and coordinators that have stood up in states, in regions, and in individual cities who are doing a lot of the heavy lifting to connect investors and capital with communities and projects. And that infrastructure is really going to become important here as we get into the rebuilding phase of this next chapter of the country's history. And so we already are seeing and hearing from a lot of those local market coordinators that they are being tapped by their state government, by their city government, and by the local business community to help lead the charge on how to reinvigorate those local markets. And so that's going to be something we watch very closely over time, is how much do those coordinators, what do they report in terms of the level of interest they're continuing to see, what type of local support they're getting from state and local government, and how long of a tail the effects of the COVID crisis are going to have in terms of the practicality of getting projects out of the ground. But again, right now I'm pretty bullish because a lot of that infrastructure had already been built by the time this hit, and now it can be used to actually help the country in these places rebuild the way that we all hope it will. So let me stop there and answer some questions.
Absolutely. Everyone, Marco Vienna with 4 Points Funding. Thank you so much, John. I really enjoyed your presentation, your information on opportunity zones. We have one question here so far. If there's any other questions, how you ask them is there's a little Q&A button and you can type them in there. If you have any questions for John, please do so now, or if you think of any later, I can make sure to email him and ask. But John, the one question here is, what is the expected size of the total investment expected through the entire OZ incentive?
It's a good question. It's one that we hear a lot, and that there's just no way to know. I can tell you what others have said, and then I can give you my best guess, but that's all it is. It's a guess. Secretary Mnuchin, the Treasury Secretary, has predicted that upwards of $100 billion in total investment will flow through this program over its life cycle. I think the numbers we were seeing as of January would indicate we'd be ahead of schedule on that. Again, I think the multiple on that $7.5 billion number I gave you in January is probably 2 or 3. So if there's $7 billion being reported through this voluntary survey that captures one subset of the market, I think the actual number is closer to 20, 25 billion. So that's before you really have the effect of final regs in hand. That survey was not capturing the post-final regs environment. And we just know from every bit of anecdote that we draw from that once the regs were done, the fundraising process was accelerating dramatically, like flipping on a switch for a lot of fund managers who have been courting interested investors. A lot on the investor side, a lot of folks have been told to pump the brakes until final regs, so that there was no chance that the rug would get pulled out from under any particular investor or fund strategy. With that gone, with that uncertainty gone, we were seeing a massive ramp up. So all that to say, I think 100 billion is the number you hear commonly thrown around thanks to Treasury. I think it could easily be more than that. Again, with capital gains being the source capital for this entire program, you can in some ways peg the eventual amount invested to how much is available. And as of the end of 2019, there had never been more unrealized capital gains in the hands of U.S. investors and corporations than there was at the end of 2019. That's obviously changed, but again, the sell-off created realized capital gains that now have to be deployed in order to achieve the opportunities on benefits. So that in some ways could have accelerated some of the buy-in. We just have to wait and see a little bit.
Absolutely. I see a few more questions coming in about the incentive in specific and how capital gains are discounted and things like that. We'll actually be going over that in just a couple slides after John departs. But one more question for you, John, is there
Marco, before you go there, one question that I think would be relevant for John around the discounted cap gain, sorry to interrupt, is we had a question come in around, would you expect the additional 5% step up in basis after 7 years would be retroactive to 2020? Meaning, if it was extended, would investments that were made this year count if it were extended sometime in the future?
That would be my expectation. That would be my expectation. It would not be prospective. It would look at whatever timing was the commencing of your investment. You'd be capturing the benefit from 5 and 7 years of that point forward. Or it could even be different. They could change from 5 and 7 years to 3 and 5 years, for example, just lower that threshold so that it's easier to achieve without actually extending the back date of the program. So there's different ways to achieve the same result, and that second one is my preferred change. It doesn't push the end date of opportunity zones as a policy back, but it changes the underlying components so that the benefit is easier to achieve later in the investment window than what the original bill would have allowed. But in any case, I would expect it to be retroactive.
Great. And John, one more question for you. Is there any serious risk that the program goes away because of the upcoming election year, or any politics as far as having more conservative or democratic people in power?
That's a good question. Again, best guesses all the way around here. I'll just note a couple things. One, the only candidate who said anything publicly that could be interpreted as "I'm going to repeal opportunity zones" was Bernie Sanders. So if Bernie Sanders was the presumptive nominee right now, I would hedge my answer a little bit more than I'm going to. But even if he had been the nominee, and even if Sanders had become president, I still think that the crux of the program would have been safe. And I think that, for the reasons I said earlier, the depth of support on a state and local level that this has among mayors and governors, in particular Democratic mayors and governors, is pretty profound. And to penalize communities that are just starting to see real benefit from this in states like, I'm just going to randomly pick a few here, Ohio, Pennsylvania, Wisconsin, Michigan, that's bad policy and could be interpreted as bad politics as well. And so I think that was going to always be a big hurdle, no matter what a nominee said, in terms of what was doable. Because not only does the president have to decide, it has to get through Congress. And I think the idea of repealing opportunity zones full stop is it's unimaginable to me, given the reality on the ground. But Sanders is not the presumptive nominee, Joe Biden is. And so in a Joe Biden universe, in a context where, as we've talked about on this call, the economy is going to be struggling to rebuild, and particularly struggling to rebuild in areas that are higher need. The idea of taking tools off the table in that context, especially the most powerful tool that we've ever had in a national policy environment, seems again like bad politics and bad policy. And I think that's how whomever is the eventual president in 2021, and whomever is in control of Congress at that time, I think there's going to be pretty strong consensus that we need more resources and more tools, not fewer. And again, by that point, opportunity zones will be even more deeply entrenched in the economic development playbook for a lot of the very same communities that are getting so much attention today. So that's a long answer to a short question. I think there's relatively low risk. I'd say very low risk to a repeal due to political reasons. I think there's a reasonable chance, not a risk, but an opportunity to make further improvements to the bill that are both good for the market and good for its political durability. And that's what we've been working on here at EIG.
Great. And John, one more before you go. You mentioned there's talk of potentially limiting some specific qualified opportunity zones. Do you think projects already underway in one of those zones would be grandfathered if it happens?
Yeah, so the cardinal rule of tax policy is you don't retroactively claw back benefits that were, as long as an activity was undertaken in accordance with the rules of the time and in good faith, without any kind of fraud or bad behavior involved. It's just a cardinal rule of tax policy not to retroactively unwind benefits or claw anything back. So I think there'd be a strong priority given to making sure that anything that had been done to date was grandfathered in. It's not to say it might not be disruptive in some way, but we're talking about an extraordinarily small sliver of tracks that would even be up for discussion in this context. So this is not, for 99% of opportunity zone investors, this will never apply. It will never even become a consideration. For those that are already focused or already up and running, already investing in those tracks that may be under consideration, it's a pretty safe bet that their existing investments won't be affected. So what Congress would intend to do is prospectively sunset, and not even immediately, but sunset earlier than the legislation originally would have required, the highest performing tracks, ones that had the weakest argument for being opportunity zones in the first place, on some kind of go forward basis. So again, pretty heavy priority on making sure that it's as non-disruptive to existing investments as possible, and that there's a runway, an off-ramp to kind of an orderly transition from current opportunity zone status to being sunset.
Great. John, thank you so much for joining us. We really appreciate your time and knowledge. And the next part of this presentation will be more focused on 4 Points funding in specific.
Thank you, John. We'll talk to you soon. Thanks again.
Thanks very much. It's great to be with you. I'm a huge fan of 4 Points, and have been a good friend, I think, of Stephanie's, in spite of all of our idiosyncrasies. We really have appreciated and learned so much from what your team has done at 4 Points, and how you've navigated this early market better than almost anybody. So thanks for giving me this chance to talk to your team.
Thanks, John. Take care.
Thank you.
All right. So thanks everyone for, again, we will definitely send out all the Q&A that we get, and make sure that this is written, as well as the recording of this. We're going to go into a very brief section. Just one thing I want to mention. Today, actually, in Forbes, we were awarded this about a month ago, but at the end of last year, we were actually awarded from Forbes, one of their new lists. We were named one of the top 10 opportunity zone funds in the country. In early February, we are awarded as the top in our category, and that's focused specifically on small and emerging markets, the rural marketplace. And today, an article and video came out about our award, and we're really proud to have been recognized as that kind of catalyst. And this is not easy work, forging new capital flows into new areas, but we think that it has so much mutual benefit, both between the impact to the community and the opportunity to create meaningful returns for investors, that we are greatly encouraged by our early activity. So I'm going to turn it now over to Chris to go over a few things on how the fund is doing.
Great. Real quick, I'm just going to introduce Stephanie and Chris, my partners at 4 Points Funding. So Stephanie led economic development for the state of Colorado, and during her tenure, she was designating the opportunity zones here in Colorado. And she has a lot of infrastructure investment experience prior to working for the state as the president at Zayo Group. And she's also a member of the board of directors at Techstars. And then Chris Montgomery has invested in real estate at scale since the early 2000s. The western slope of Colorado has been a focus since 2013, placing over 300 real estate investments in the region, and investing in these communities well before the opportunity zones were designated has been very advantageous for 4 Points Funding. I'll see you guys in a little bit.
Thanks, Marco. I should have learned at the last conference not to be the guy following John, but somebody's got to do it, so I'll jump in there. I'm going to keep my remarks pretty brief. Several of you have heard some of this before, but we want to give just a very brief overview of the opportunity zone itself. There were a couple of questions that didn't get answered that we didn't send out to John. I'm going to talk a little bit very briefly about the incentive. If you have deeper questions, we're always happy to answer those. This is just an overview, happy to dive in separately. So if you have questions on that, please email us directly. We'd love to spend time with you answering those. But at its core, as John said, this is a long-term incentive. It's designed to pull capital gains off the sideline and keep these invested in the opportunity zones. And it's time-based, so the longer you leave them in there, the more benefits you get. Where we are right now is you get to defer the gains on your existing investment. So you invest capital gains within 180 days of realizing those gains into a fund such as ours. When you do that, you're able to defer your taxes through the end of 2026, meaning you're paying them in 2027. John talked about the fact that the deferred amount will be reduced. Currently, where we are right now is a 10% increase in basis, which means a 10% decrease in the taxes that are owed if you invest anytime between now and 2021. And then the big benefit, if you hold your gain for 10 years inside the fund, you completely eliminate any of the gains on that fund, on those existing capital gains. Sorry, I was trying to speed up because John took extra time. So let me make sure I'm clear on that. All of the new gains within the fund are going to be tax-free completely, including an elimination of any depreciation recapture. So with that, that's a huge benefit. Our fund in particular is specifically targeted at a 10-year hold. We want to make sure that everything that we do is right down the middle of the path for the incentive. Everything that we invest in is intended to have a 10-year hold. So I'll talk a little bit about the theme that we have, as well as the structure of our fund. And then I'll turn it over to Stephanie to talk a little bit about what we're doing in light of kind of what we're seeing in light of the current crisis. So thematically, we have two major categories, the biggest of which in our current fund and our future funds is going to be multifamily housing. There's a clear demand based on where we're investing, which is all of Colorado outside the urban corridor, but particularly in the Western Slope. Long-term statistics show that there's clear influx of people. So multifamily housing is our biggest single focus. We also have a hospitality focus, but for us, hospitality can mean something different. In many cases, it's outdoor focused hospitality. So glamping, recreational RV parks, tiny homes. There's some creative types of hospitality that make sense even in the current climate. Stephanie will talk a little bit more about that. Geographically, it's really about absorption for us. We want to have the right size project in the right area. So we're investing into geographies that can absorb the investment that we have. They tend to be underinvested, but that's an advantage for us. We think that there's some undervalued assets that we can take advantage of and bring into the fund. And importantly, we want to coordinate everything with the community stakeholders. We're not someone that's going to come in and dictate to a community or just make a blind investment. We want to invest in things that the community stakeholders are part of, local developers, local economic development people. We want to listen to them, invest in something that's going to support the community long-term. And importantly, it'll also de-risk the investments that we're making. We also think that there's a long-term opportunity to have some optionality around how we exit from these assets. We can sell the assets individually, but we also think within the multifamily housing in particular, there's the opportunity to do some roll-ups and really add value to have a premium on the portfolio. So thematically, that's where we're focused. Structurally, what we've done is something a little bit unique in the opportunity zone world. Marco, if you can move on to the next slide there. One of the things that we've done is try to align what we're investing in with the incentives for the limited partners. When you exit from an asset and you realize your capital gain, you have 180 days to invest it into a fund. What we want to make sure that we're able to do is always have a fund available, because those gains tend to come on random schedules. We want to make sure we always have a fund available for our limited partners. Everything really is driven from their schedule. So with that, we're setting up a series of 6-month funds. Fund 1, our first fund that was before the regs were finalized, has now been closed, and we're in the middle of Fund 2. With this, we're going to have a series of some smaller, really high value, high impact projects that'll be wholly owned by each fund. And then some of our larger projects, generally in the $5 to $10 million of equity scale, will be split across 2 funds, but no more than 2 funds. We'll cover those in just a second. What you can see though is that we'll always have projects moving forward available into these funds. Again, some projects will span a couple of funds. What we didn't want to do is have one larger, longer term fund. What that would do is it would put the people that invested last year on the same clock as somebody that invests 2 years from now. Then you end up on a 13-year clock. We're very sensitive to the fact that 10 years is already a long time to hold. So what we're doing is trying to keep it as close to possible as a 10 and a half year hold time for each of our funds. And with that, I'll turn it over to Stephanie to talk about what we're seeing in Fund 2 and in the markets.
Sure. And as Chris mentioned in our portfolio, the one that is intersecting with Fund 2, we have 3 projects that are secured and underway, a total of about $15 million that we're currently raising. The projects require $20 million in equity. We're raising the next $15 million now, against which we have some equity available. These projects range from, to Chris's point, multifamily, workforce housing. So thematically, we are targeting the missing middle housing sector, which is acute in many of these Western Slope communities, particularly those that are near and adjacent to resort communities, as well as some hospitality. We'll talk a little bit about the last investment that we've made, which is a smaller investment, with one of the ones that we're probably thematically most excited about, given the intersection of the impact on the community, the returns, as well as a unique way to transition an asset into its best use. The site that we have in Grand Junction, well underway. We're in our application process with the city on a use by right project for 96 units of multifamily housing right along the riverfront in Grand Junction, that is directly adjacent to a large redevelopment that the city is doing to revitalize the riverfront with a whitewater park, an office park that will house 2 larger outdoor rec manufacturers, and is right next to the city's amphitheater. So it is a new kind of walking distance from downtown, revitalized area for that community, addressing the need for affordable, nicely categorized workforce housing. Very similar project in Glenwood Springs. It's a transit-oriented development that sits directly adjacent to the Roaring Fork Transit Authority Central Hub, providing access to the residents of the community, direct transportation up and down the valley in the Roaring Fork area, which again is a very urgent need to provide more housing, specifically made available to teachers, to nurses, to accountants, to other professionals in the Roaring Fork Valley that need quality but affordable housing in this area, which has been greatly needed. And the last development, which again is almost hard to describe in one word, so again, it's a smaller investment, but this is 120 acres on the San Miguel River, anchored by the San Miguel River, which used to be a mining camp and had 14 historic cabins on it. We are repurposing those cabins to be glamping campsite with both access to outdoor amenities, rapidly growing trail system connecting that really brings overflow in from Moab, as well as accessible easily from Telluride. It's kind of directly in between. It has a very large art installation that will then both become a destination for this cohort of travelers, outdoor enthusiasts, specifically ATV and mountain bikers. And we're partnering there with a really exciting operator who actually grew up in Natarita, but has spent her majority of her professional career in Telluride and high-end hospitality, and is really bringing new destination to this place. So we have a lot of belief in this project, and thematically that there are many other places that can benefit from this type of outdoor recreation and outdoor lodging, especially in the current environments. We have in our multifamily housing sites, we are not developers. We have partnered with a very established and experienced multifamily housing developer who is on the Western Slope and is working with us on both projects. And we are making great headway. We expect them to be, again, not only directly impactful to provide more supply for the communities, but also to create very nice cash flowing returns for our investors. So I'll turn it back over to you, Chris. Actually, I'm going to keep it on myself. Sorry, that's not true. I'm going to keep going. Let me talk a little bit about some of the observations that we've seen in the backdrop of the virus and today's economic state, which is just unimaginably different than it was 60 days ago. But we're still coming to understand what it's going to mean. So just some few, maybe obvious, but things we're keeping our eye on and things that we're seeing. One is, all of our projects will be in some way leveraged. And while we are leveraging them very conservatively, but we're doing that appropriately, we will have leverage on these projects. And while functioning, many of the debt providers and the lenders are functioning, but overwhelmed with PPP applications. And while we don't believe that timing will impact our ability to access capital, as we have interest from many of the banks and lenders already, we are keeping a close eye on that and making sure that we've got all kinds of backup plans in the event that in the next 2 years we cannot get leverage, which again, we think is highly unlikely, but we're keeping our eye on that. General contractors, one of the things we thought is that we've been in a very tight labor market, and that has driven construction prices up pretty dramatically. And we are not seeing any movement yet from general contractors around what the real employment situation, how that will impact their costs, how hungry they will get for projects. We will take advantage of loosening labor markets in a very fair way if they do occur, but we're not seeing that change yet. And we're just, again, keeping our eye on that. And then finally, given where we are in the entitlement processes, we wanted to make sure that the city processes are moving along and that approvals and meetings would not slow down or discontinue. And in fact, we've been encouraged to see that's not the case. We have had a number of virtual meetings, and we're on the same path that we were 30 days ago, and have had several virtual meetings in all of our communities that are official approval meetings for these projects. So we've had really good support there, but again, keeping our eye on that. And then moving on to the economic outlook, you know, the thing that we, again, always want to keep our mind on is we've got to be flexible in order to make sure that we adjust for anything that can hit us, including something that I think nobody could have predicted, a 100-year pandemic. But these are some of our outlooks that we're currently forming, given where we are. First, we see an even increased demand for workforce housing and affordability in the aftermath of this pandemic. So we think that's just going to become even more necessary. We do have a near term, we believe, opportunity to take advantage of a loosening labor market, which again, we would be very fair, but we think that could be beneficial. And we also think that, you know, one of the silver linings that the historically low interest rate environment is likely to persist even longer than we thought, which we will take advantage of and can lead to improvements in our capital stack. We do believe that offsetting that, the near-term housing rents are likely to flatten, and we've factored that into our modeling. We have factored in a little bit of expense flattening, but not much. And then we do think that there's some potential for new hospitality trends, like we talked about, like outdoor lodging instead of confined spaces in hotels, for those trends to accelerate, and we're positioned really well to take advantage of that. So with that, I will now turn it back over to Chris.
Yeah, and so to be specific on that, how are we moving forward in light of these things? Stephanie's really addressed the first one about the debt market already, but we're aware this is an unprecedented times. I know we're already getting some questions online about what the impact to the bottom line is, and I'll talk about that a little bit on the next slide. But specifically, how are we addressing those things? One of those is that we are very focused on preserving cash and leveraging what is a very strong balance sheet. We're fortunate to have a balance sheet provided to us in addition to just the funds that we're raising. It allows us to be certain that we can move these projects forward. If we have to move forward at a lower leverage rate, we're in a financial position to be able to do that. We're cautiously optimistic within a couple of our key investment areas. Having committed projects right now is actually a position of strength. We're seeing several projects fall away. The projects that were people considering getting into have really been placed on hold. If we're able to move forward during this period of time, we think that that can be a position of strength. We've already addressed the housing being clear on ongoing demand. Hospitality, on the other hand, is something that we've had to put on hold from a traditional perspective. We've actually placed one of the projects that we were pursuing completely on hold. We think it would be the wrong decision to be trying to raise money, both equity and debt, in light of where we are as a country. We actually have a hospitality project that was supposed to break down and have a ribbon cutting for us last week, and we're affected like other people. We've had to place that on hold. Fortunately, there's hopefully some things we can do with that to help the community in the meantime. Long term, we don't think behaviors are changing. People want to get out. The hospitality that we are chasing is something that we think will be, even in the short term when it's able to open, something that people really like. But for clarity, we've placed our larger hospitality projects on hold for now. We've talked a little bit already about the idea of pursuing cost savings. One of the things that we're doing as well is we're waiting right now to move additional projects in the pipeline. When we showed the chart of multiple funds, multiple projects, we're still actively working on that pipeline. We'll be opportunistic with that pipeline. We think there'll be opportunity to take advantage of really even better deals as they come down in the future. But we're focusing on the deals that we have to make sure that those can be de-risked, can be successful with the projects that we have. And then once we get clear insight into market conditions, that'll be the right time to take on new projects. So those are a couple of specific changes that we're addressing. We don't want to pivot too quickly. We don't want to panic or react to things, but we want to act responsibly in the current climate. So full steam ahead from a fundraising perspective, from taking taking the projects that we have now forward, and then pausing on other things until we get some more clarity in both the market and the debt market. And with the returns in particular, answer that on the next slide. So what are we targeting? These are our initial targets that we've been talking about for a while. Forecasting any of the returns that we talk about. I'm supposed to read the disclaimer: investing for accredited investors only. These are pro forma estimates, no guarantees. Just, you know, boilerplate that we need to say. But it's important. These are what we're projecting. When we project things, it's net of fund fees, but without factoring in the opportunity zone benefits. The reason we do it that way is so that if you're comparing our investments to another investment, you can do that on a risk-adjusted basis. So we're targeting a 12% IRR across our investments. That's roughly a 2.5x multiple on your equity multiple over that 10-year hold period. I really want to emphasize the 10 years. We're not trying to time the market. What we're trying to do is invest now into properties that will be long-term cash flowing properties. So we begin cash flowing generally at the end of year 2. We're developing these properties. We will distribute all of the cash back out to our investors. I know there's been some questions about the cash on cash returns that we will see. Cash on cash return we're predicting is just generally in the 7 to 9% on an annual basis. That gets then turned into a 12% IRR when we sell the assets long term. The opportunity zone benefit is generally between 30 and 40% of a net improvement. But because that's so investor specific, we don't want to advertise a particular number, though we're always happy to talk to you about your situation and how that can apply. We don't think that, we think it would be the wrong time to try to figure out exactly what is there a particular multiple that COVID is doing to us? And the answer is we're not sure yet, but we're investing for the long term because we're not trying to build luxury condos that must be sold 6 months from now. What we're trying to do is build something that has a strong long-term demand, that has cash flow, and that is going to be able to be sold at the right time 10 years, post 10 years. And with that, I'm going to turn it over to, I know we have a little bit of time left for questions. If any questions have been typed that we did not get to, we'll make sure, and again, get those back to you. We've got a couple minutes left here for questions.
Let me add one thing to what Chris just said about the COVID-19 impacts. I think it's really prudent for us to say we do not have a crystal ball and understand this. But as we look over the horizon, we see as many positive benefits to offsetting negative benefits, to not believe there's going to be material impact over the life of the fund. But really, as we get more clarity coming into the latter part of the year, we'll be better understanding where that will balance out. Again, positive benefits being potentially moving into an even more friendly rate environment that we expected and more friendly cost. Negatives being maybe flatter rental rates, maybe offset by some reduction in expense increases that we're expecting. But we're being very, very careful about what our lease up looks like, what our rental rate escalations look like, our expense escalation, and how we can offset multiple scenarios against taking benefits of potential lower cost of capital and a loosening labor market. So we think those offset, and we continue to believe in this. Chris and I are both also co-investors in this fund, and we continue to invest our capital gains here. So we think this is still a very beneficial environment for this type of investment, and we believe that these communities are going to need it now more than ever.
And with that too, I would say, please reach out. We are always available directly. You get the contact information for both Stephanie and I directly. We would be more than happy to set up times to talk via video at the moment, but would always be happy to talk with you as you have any questions that we can answer for you. I tried to answer a couple of the questions integrated into it. I know from a time perspective, we're running right up against our hour here. I think that what we'll do is
one last thing to mention is before we sign off, Chris, Sean, myself, our team, we have a wide network of opportunity zone stakeholders across the country, from the legislative support to other financial institutions across the impact spectrum as well as non-impact spectrum. If there's ever anyone that we can connect you to that would be helpful in answering your questions, we'd be more than happy to do that. And if we can ever help in answering, just structuring anything around the Opportunity Zone funds, we'd like to make sure we play a helpful role there as well. So really appreciate just all the time you spent with us today, and thanks for just being with us. And I'll turn it over, Chris. Any last words?
No, it's crazy times we're in. We really appreciate everyone taking the time to spend this time with us. As you can see, we're all in our homes, as many of you are, and we appreciate you joining us here today. Thank you very much. And I think with that, we will sign off. Thank you very much.
Thanks, everyone. Bye.
Thank you.